Well, on the march to 16,000, then someone got in the way. Welcome, everybody. I'm Neil Cavuto, and this is your world. So close on a day the Dow was flirting with history by hitting Sweet 16 and staying over Sweet 16, it reverses course. A billionaire investor turning sour. His name is Carl Icahn, warning we could be on the verge of a big stock market drop. We'll get into what he said, but we've got you covered with the fallout since. With Ben Willis at the NYSE on where we go from here, Money Watch's Lindsay Piegza and Mark Vittner on whether the average investor is feeling richer here, and Dave Maney in Denver on the one thing that could help the market propel even higher from here. First to Wall Street and Ben Willis at the New York Stock Exchange. Ben, first off to Carl Icahn putting out a warning in the middle of a party, more or less saying that a lot of this is being propelled by a very generous Fed that's just handing out candy. What do you make of that?
Well, I had my party hat already, and you know he kind of took that away from us. And he's not wrong that the Fed is fanning this, but that's their job. That's what the whole point of quantitative easing, or going back to TARP. They're trying to reignite the flame of the economy. I believe they're starting to succeed in that, which is why I think taper is not a bad thing. Rising interest rates are the smoke of the fire, and that's for equity investors, that's going to be a very good thing.
You know, he's a pretty shrewd investor for his close to 80 years on this planet. He's like one of these vulture investors who finds opportunity where others do not, or he sees that maybe if he can stir up some dust, he can get a big response in the stock. So he was already bemoaning Apple and his investment there. But now he seems to be broadening this out. Now, if it were not Carl Icahn, we probably wouldn't pay as much attention, or do you think the market used that as an excuse to just take a breather in this run for 16,000?
Every professional investor you talk to in the last few weeks has been very intimidated by this bull run. We've been calling this bull Tina. There is no alternative. And the fact of the matter is, Carl Icahn was pointing out what most professional investors, I've been in this business for 30 years. I'm concerned about the speed that we've managed to hit 16,000. That's not necessarily a healthy thing. But again, Carl Icahn, if you're a buyer, of course you're going to tell the seller that you're really not that impressed with the goods. So I think that's part of his plan.
So he might have had an agenda, you're saying.
Oh, I think he's always had an agenda. Never knew him not to.
All right, so let's step back and take a look at what maybe these markets are telling us right now in this pursuit of 16,000, whether it is rich. I mean, many could look at that and say, on a price earnings basis, a popular measure by which we judge value, the Dow is, you know, not cheap, but not obscenely rich. Do you agree with that?
Not at all. I agree. It is. As far as historical measurements go, we're in the middle of the range, so to speak, and that is we're in the middle of the range of an otherwise very slow and painful recovery. We should be much further along, quite frankly. But the fact of the matter is, this has been the slowest recovery I've ever seen in my lifetime. We should be much further ahead, and therefore so should the Dow. But that's the reason the Fed has had the excuse not to pull away from the market, that they continue to intervene in places with the quantitative easing in the Treasury market, which quite frankly has not been effective. The effectiveness has been in the mortgage-backed securities area. Right. So that's all been part and parcel. So for an investor, if there is no alternative, bonds are certainly not the place. If you plan on retiring anytime soon, bonds is not the place for you to have your money. It's going to be equities, and there will be corrections, and that'll be a time for you to be adding to your portfolio, not panicking, running away.
All right, we shall see. Ben Willis, thank you, my friend. We are definitely noticing a trend here that the worse the healthcare rollout gets, generally, not all the time, but generally, the higher the stock market goes. Dave Maney calls this the Obamacare rally as a result. So, Dave, the thinking goes like this. The worse it looks for a big government initiative, the better it looks for the private sector. Is that the gist of it?
Well, there's some of that, but to me, it's a little bit like The Wizard of Oz, where, you know, to some extent, Obamacare is the house, and the house has landed on the witch from the business community's perspective, which has been the president, who is not a friendly guy to profits or capitalism or entrepreneurship or investment in businesses. And when that house lands, and figuratively speaking, the wicked witch is dead, guess what? The munchkins come out in the street and celebrate. And I think you're seeing some of that. And remember, this is not just the healthcare side of it. This is also, you're seeing it in op-ed after op-ed where folks say this might be kind of the end of the progressivism of the successful prosecution of a kind of a leftist agenda by this administration. And so on a number of fronts, whether it's union rules, whether it's environmental and global warming policies, all of these things that this administration has said are so important to it are now deeply at risk, and that lends itself to a large degree of economic vitality and excitement, and that's what's been missing from this market.
You know, David, I got to tell you, there's something, not you, my friend, but among the swarmy worms you might talk to who are your colleagues, that they resent it when we do anything, let's say, big government-wise for, let's say, a healthcare initiative. They're perfectly fine when it's the Federal Reserve providing $85 billion a month for them to keep this party going. So me detects a double standard, but that's just me.
Neil, I couldn't agree with you more. Like, but what you have in some way is a rally that has had two elements to it. One, the artificial fuel that the Fed keeps shoveling on the fire. But two, remember, is this technological wave. The real results of this information wave has been to strip enormous amounts of inefficiency and expense out of the economy. That's why the profits have been great, but the revenues and the dynamism of the economy haven't been. So you're absolutely right. It is a two-pronged thing. And what I'm saying to you is if you add in a third prong now of real, clear runway, economic growth and energy, you could see a lot more things happening.
We shall see. David, thank you as always. We were just showing you those numbers on the Dow. While not 16,000, again, this is good enough for a record. I believe it's 39th of the year. So stocks are running rich, but are you feeling rich for it? Lindsay Biegsa says there is something about 16,000 or close to it that helps, but Mark Vintner says it takes more than a seminal level on the Dow to change people's psyche. So Lindsay, just the talk about going in and out of record territory, hitting 39 records for the Dow, a commensurate number for the S&P. That's enough to make people feel better?
There's certainly a significant impact. There's a wealth effect. When individuals see their investment portfolio rising in value, they feel wealthier. They feel more confident. Even individuals that are not necessarily invested in the stock market, they read that market report about a new high, and they feel more confident because that suggests that things are improving.
So if
in the
they had doubts
economy.
about going to the store, they're less doubtful about going to the store?
Exactly. Now, there's plenty of reasons for the consumer to be pessimistic. Uneven job creation, minimal income growth, but the fact that consumer confidence is still above 70 suggests that something is putting a floor there, and that something is the rising equity market.
Mark, you sense a trap, though. Is that the gist of it?
Well, I don't think that we've had that much of a wealth effect. Certainly, if you look at the flow of funds data, you see that household wealth is back above where it was pre-crisis. But the gains are very heavily skewed toward the upper end. The Federal Reserve Bank of St. Louis did a study where they looked to see how evenly the gains from the stock market have been since the recession ended. The top 7% of households, the 7% wealthiest households, have seen the value of their stock holdings go up. The other 93% have actually seen them go down, even though we've had the stocks run up to record levels. The truth is that middle income and upper middle income households just haven't been aboard the rally. And so they've missed it. And consumer confidence has had the slowest recovery that we've ever seen. It's still lower today than it was at the depths of the 2001 recession. So it's moving in the right direction, but we're looking at a pretty soft Christmas. The one area that's doing very well, though, the upper end. We just had a bunch of art auctions in New York last week. Record prices for all these paintings, $15 million Ferraris. There's some incredible stuff going on at the upper end.
I can't believe the 100 million plus for the one painting, but I digress. I guess there is this dichotomy, Lindsay, and that it might benefit the Cartiers and the Tiffany's, but when you're hearing from Walmart, whose U.S. CEO talked to us on Fox Business, you're not seeing it there. So that we might see this sort of quite literally bifurcation this holiday where it's a split read. The upper income spending like crazy, everyone else not.
I think retailers are right to brace for a lackluster holiday season, but I would argue that it would be even worse if we didn't see this run up in equities. Consumers would pull back even further.
Even for people who aren't part of this, they just read the headlines or look at this and say, well, something must be going well.
Well, there's a very big psychological element. People look at that, they hear about those numbers and say things are improving. So you know what? I'm going to go out and spend this Christmas and worry about it next year.
You know, Mark, I hear that kind of thing, and it's always on the other side, too. If the market sinks fast, it has a chilling effect on people because presumably they have less paper wealth, much as we attach to the value of their homes. Which is more important, though, with the value of homes increasing, albeit not at the pace they were, but they are increasing, and their portfolio is increasing. Longer term, is that going to be helpful?
Well, longer term it's helpful. I think that the increase in the value of homes has helped more in the last year than the rise in the stock market, because more people have exposure to the housing market. But a lot of folks still are hoping for more on the housing front. They haven't regained as much as prices had fallen off. But it's better to have a rising stock market than a declining stock market, because one of the things about a rising market is it makes you feel a little bit more secure about your job. Because job gains are associated with a rising market, job losses associated with a weak stock market. So there is some benefit to psyche from that. All things considered, you want a stronger stock market for a lot of reasons, more than a weaker
and of course,
market.
lower gas prices are going to help supplement holiday spending as well.
Yeah, we shall see. That we'll know in earnest very soon. So now we know millions are losing their current health plans, and this Democrat says her party knew it all along. Even bigger problem for this president, maybe this market?